Changes in the tax code, particularly with respect to the state and local tax deduction and the mortgage interest deduction, are on everyone's mind. Hey, these issues are of particular relevance to homeowners in high-tax states. Now that tax reform is done, and it's a done deal, it's important to look at the factual implications for homeowners. Number one, the mortgage interest deduction is capped at $750,000. Previously, it was capped at $1 million. The old cap has been grandfathered for current homeowners. Number two, state and local tax deductions are capped at $10,000. The state and local tax deduction used to have no limits. Number three, the standard deduction will nearly double. It was $6,350 for individuals and $12,700 for couples. It's now $12,000 per year for individuals and $24,000 for couples filing jointly. This increase might encourage some to take the standard deduction rather than itemizing. Number four, the mortgage interest deduction on home equity loans has been eliminated. Number five, the capital gains exclusion remains intact. According to the NAR, National Association of Realtors, only 6% of homeowners have mortgages exceeding $750,000, and only 5% pay more than $10,000 in property taxes. But most homeowners won't itemize under the new tax laws anyway because the increase in the standard deduction. The first-time home buyer will have the least impact as they tend to purchase entry-level homes in a median home price. The biggest impact may be on luxury homes. The bottom line is that you hear a lot of interpretations, positive and negative both, but the facts are clear and everyone should consult with their tax accountant on how this will impact them personally. Overall, the experts are predicting very little impact on the housing market for 95% of the buyers and sellers. None of the tax reform facts preclude the one biggest advantage of home ownership, and that is building wealth through equity. Now for minding your own business. Hey, today's market is all about going the extra mile for your clients, especially after the deal is done. Your past client referrals are probably your biggest lead generator and your reputation by word of mouth. So how you treat your client after the transaction is closed can be a huge impact. Here's a couple of examples. Number one, review your past clients' home values for all who finance their homes with less than 20% down. Connect them with your lender to see if they have enough equity to refinance out of their mortgage insurance or do a streamline to lower their mortgage payment. Number two, before the end of the first year of ownership, call your clients to remind them that their home warranty will expire and get them in contact with a representative to decide if they should continue the policy or if it's necessary. Why should you do either of these? Well, number one, it tells them that you care about them, not just the commission you made on their transaction and then they're forgotten. Number two, it elevates your value as an agent and increases the likelihood that they're going to refer you or call when they need to move. That's this week's Real Estate Insider Weekly. Thank you for joining me again. Have a great week.